This is Barry Knapp with Ironsides Macroeconomics. It's Sunday evening, November 12th at about 6:15 p.m. Mountain Time. This is the free version of our weekly summary for all of you that aren't paid subscribers. Please note we did release the entire note to you last week. We hope you read it, enjoyed it, and will consider becoming a full subscriber. We'll do that periodically to give you a sense of what it's like. And we could certainly offer trials for anyone who wants them. Our note this week was titled Crossroads. We discussed the failed 30-year auction last week and how that supported our thesis that the changes in Treasury issuance greater than recommended bill issuance as a percent of the total, more issuance in the belly of the curve and less issuance in the back end was little more than a Band-Aid that we didn't think would be particularly effective. Our real message here for the Treasury market on balance is that all rallies in Treasuries are suspect unless they are led by twos, right? So this ultimately can only come about one way, and that's from the Fed confirming that they're no longer going to hike rates further and beginning to contemplate, even if not openly, rate cuts. And so we really do need a two-year note driven rally for any rally in the Treasury market to be sustainable. In essence, the banking system and investors really can't support Treasury issuance without a positively sloped yield curve. And the only way we're likely to get that is when the Fed starts cutting rates. So we then went on and discussed how the Fed made it abundantly clear last week that what they'd done was something more of a policy put, meaning 10s push through 5%, the stock market's down 10%, that sort of tightening of financial conditions, an increase in the dollar, of course, those sort of tightening of financial conditions would preclude any more rate hikes. But they've not been convinced by the data. And quite frankly, we were surprised at how hawkish so many of them sounded following the payroll report that we received on the Friday, 2 days after the FOMC meeting. That to us looked like a very weak report. I suppose we need at least a 4% unemployment rate for 3 months that triggers the SOM rule to really convince the Fed that they are starting to fail on their employment mandate. So that was another section of the note this week. We then discussed, we revisited our 94 analog, which was the penultimate soft landing, if that's the right adjective to put in front of that, but that was a soft landing scenario. But there's some key differences from 94. The banking system's in much worse shape. The curve inversion is much deeper. And we've got a regulatory storm brewing in the banking system, which we dug into in detail. Fed Governor Bowman gave two speeches last week that hinted to us that she may be taking her fight to the streets here, so to speak, because she has no support from Barr, Powell, and the administration clearly wants to raise the level of bank capital. The comment period will be done in January. So again, in the early 90s, the bank regulatory policy was actually loosening. So another issue for the markets in general, as well as the macroeconomy, is the administration's push to force banks to hold even more capital than they currently are. We then previewed the CPI report this week. It'll be out Tuesday. There were a couple of quirky things that happened over the last month or two to housing or shelter jumped last week mysteriously, or last month mysteriously, and non-housing services had been up 0.5% 2 months in a row after 10 months of averaging 0.22. We think that those are likely to reverse a little bit this week, but we're going to need a few months of weaker inflation to get the Fed's policy put to turn into a full pivot. And we don't think inflation will be enough. We think the labor market will have to deteriorate enough for them to become convinced that they're failing on that mandate. So final thoughts, the tech stocks led the rally last week. We don't think there's a lot of upside to the market. We're at 4,400, maybe 45. The downside is somewhat protected because of this policy put, but there's no reason why the market couldn't drift back lower as well. We're going to get a lot of detail this week on consumption, on the housing market, on the manufacturing sector, and those will all help, but none of those seem like they'd be more impactful than that weak payroll report, which didn't seem to move the Fed very much. So anyway, that's it for me. If you're not a full subscriber, we'd love you to consider becoming one. Barry Knapp, Ironsides Macro. Thanks, everyone. Have a good week.